Hello and welcome. This is Amy Zhang. I'm the managing member of Affinity Fund Services, a hedge fund administration firm based in San Francisco. Today we'll talk about hedge fund capital raising. This is the second video of a series of 3 on how to start a hedge fund, a guide for emerging managers. If you have been running your fund for several years, you may visit our blog for more relevant content. Download the PDF copy of these slides by visiting our website www.affinitycpa.com, then click on the tab How to Start a Hedge Fund. First, the agenda. In this video, we discuss different investors and their pros and cons, and capital raising strategies and some practical tips. In the third and last video of this series, we discuss key service providers, how to select one that suits your fund's need, and the cost of starting and keeping a fund going. Now, investors. I will start with non-institutional investors. Emerging managers should focus on these investors since they have fewer stringent requirements regarding fund operational structure, asset level, risk, and performance management, etc. First, family and friends and other high net worth individuals. Almost all new managers have some family and friends money during initial launch. They have close relationship with you. Some may have asked you for investment advice from time to time, and a few may have trusted their retirement money with you already. Other high net worth individuals may be referred by family and friends. There are thresholds for both net worth and income level for an individual to be considered as an accredited investor or qualified purchaser for a hedge fund. Please consult your attorney for further guidance. These high net worth individuals typically require minimum due diligence before they invest and usually stick around during different market cycles. The downside is that they usually make smaller investments and may need more individual attention. Second, seeders. These investors either have a revenue sharing agreement or become an equity partner with the firm. Exact terms are up for negotiation and vary from fund to fund. What you want to cover during your negotiation: possible future funding stream, the exit plan for the seeders, and their involvement with the fund's operation and marketing. Seeders can usually provide larger funding from $5 million to $75 million. Their sweet spot is hedge funds with AUM between $25 million to $50 million, where they can come in and quickly ramp up the fund's asset level. Some seeders consider themselves VC for hedge funds and provide marketing and operational assistance to the fund as an equity holder. However, they also take a piece of cake from the fund's revenue, and it takes more time and effort to get them into the door since they are popular with startups. Now, institutional investors. These are the investors a startup fund has more difficulty raising funds in the first 6 months of fund launch. First, family offices. They are set up to manage one or multi-family's wealth. Either the family members or a group of investment professionals will be the manager. Family offices differ from each other significantly in terms of size of asset allocations, investment expertise, and risk tolerance. Second, fund of funds. They typically have a sophisticated investment team that screen fund managers and perform due diligence work. It can take anywhere between a year or 2 for a fund of funds to make an initial investment. Third, foundations and endowments that manage assets of nonprofit organizations. They usually make long-term investments and have a low turnover rate in their portfolio. They require funds to have a good risk controls, strong infrastructure system, and years of performance track records. Fourth, pension funds. They usually make long-term investments to support companies and government employees' retirement. They typically make significant investments. Fifth, sovereign wealth funds set up by governments to manage a country's wealth with a minimum investment size between 500 million to 1 billion. Unless your fund is one of the largest hedge funds, sovereign wealth funds are untouchable. Before I continue on to capital raising strategies and tips, I will talk about separate managed accounts, the SMAs. They are gaining popularity in hedge fund world. First, SMA is not a hedge fund. It is an investor account separated from the commingled hedge fund. The manager trades the account, usually using investment strategies consistent with the hedge funds, unless there are restrictions imposed by the investor. Many investors prefer SMAs for high transparency and liquidity, since the investors have the custody of the account. However, for you as the investment manager, you will have higher operational complexity with SMA account. For one single investment, you need to trade through your fund's prime broker and maybe another 5 different brokers, such as Fidelity or Charles Schwab, because that's where your 5 SMA clients put their money. And because the SMA investors enjoy higher transparency and liquidity, you may have a difficult time converting these clients into funds investors down the road. Now the topic everyone wants to learn about, capital raising. I break it down into 3 parts: marketing, negotiation, and relationship maintenance. First, marketing. Many marketing professionals spend years in practice to fine-tune the art of marketing, just as you have with your investment skills. So don't take this lightheartedly. That being said, marketing is something you can and have to learn as a business owner. You just need to be disciplined and committed. Number 1, increase your visibility. There are many ways to do so. You may go to industry networking events, attend or present at conferences or seminars, write articles for online or print investment media. Set up a marketing calendar that requires action steps. Every month, how many events will you attend? How many family members, friends, or ex-coworkers do you plan to get back in touch? How often will you reach out to local media for publicity? If you live in or near San Francisco, you may go to our website and click on Resource tab for local investment industry events this month. Number 2, make your pitch count. You work hard to get that 30-minute appointment. Don't blow it. First, your pitch book. This should be concise and PowerPoint friendly. Introduce yourself and your team. Highlight the strength. Discuss the investment program. And present the track record or model portfolio performance. We'll have a blog article to cover this topic in more details. Since some investors may never even bother to open your pitch book, your presentation is even more important. Number 1, research your audience. With family and friends, you should already know them quite well. Build on those information together with their feedback during the getting the words out process covered in our first video. Make the investors feel important and part of your business already by starting the conversation with their suggestions. Number 2, keep it short. Investors get bored as you ramble on, and they will hold that boredom against you. Focus on your strength and unique selling proposition. At the same time, resist the temptation of putting out too much too fast. Allow enough time for your audience to digest information. Otherwise, they may easily dismiss you by a simple no. Number 3, be number ready at all time. Have your latest portfolio on hand. What were the last investments you made? What's the investment process? What do you think the risk is? What's the risk management in place? Remember, the business plan we covered in the first video? Be ready to talk about that. More than 50% emerging hedge funds fail not for performance reason, but for business reason. Show them your contingency plan and how you can weather through bad time. Lastly, sell yourself. Your numbers and presentation will seal the deal, but the impression you make is the deciding factor. Unfortunately, many of the business owners start out because they know how to do something rather than how to sell. When Pandora's founder, Tim Westergram, went out to pitch to more than 300 VCs after the first round of money ran out in the early years, all he got was no. Here are some million-dollar questions. How do you change those no into yes? How do you change the unreasonable demand into a mutual beneficial agreement? That's when the negotiation comes in handy. First, there is no guaranteed way to succeed, but there are certainly some tips to increase your success rate. Remember, after people say no to you, they are already on guard. They expect you to either attack them by persuading them they're wrong, and who likes to be proved wrong, or give in by agreeing to what they ask for, or simply walk away. There are a few techniques to disarm them, and then propose your thoughts without provoking. Reassure your investor that you're not challenging him personally. Have some best alternative solutions ready, and turn them into partners who will work with you instead of against you. Negotiation can be a full course by itself. Due to the time limit, I will go into more details with scenarios in our blog post, The Art of Negotiation. Capital raising is a relationship building process, and is not a one-time thing. In addition to your periodic updates or meetings, give you a personal touch by inviting your investors to one-on-one lunch or dinner. Ask them how you may improve their experience with the fund, who within their network you should speak with. Get your investors more involved will help retention and make it easier to ask for additional funding from them and their connection. Lastly, the legal disclaimer. While I read through it, I will share two resources. First, a highly rated 30 minutes consultation. Mention this YouTube video, and I will speak with you to discuss the concerns you have for your fund launch for free. Second, our blog. Read our articles regarding various aspects of starting and running a fund. Subscribe for free so you will be notified when a new article comes out. We're currently working on topics such as finding a business partner, what to include in your pitch book, and how to market your prior performance. Thank you for watching. Our contact information is on the screen if you have any questions. I hope you will join us for our third and last video on the cost of starting and running a hedge fund. Talk to you later.